Well, our next guest says QE has altered the fundamentals of finance, which makes it tricky if you're a fundamental investor focused on cash flow. Eric Sappenfield is Managing Director at Epic Investment Partners, where he manages the shareholder yield strategies. He joins me here in studio to talk about the markets and the outlook. Nice to have you here.
Thank you. Thanks for having me.
Let's start off with I want to give the context for how you see the markets first off. You have these shareholder yield funds with an aspirational yield of 9%. So that's what you're aiming for. Before we get into how that happens, how is it going first off?
It's going pretty well.
Yeah.
The markets are rewarding companies who can return capital on a regular, transparent basis from free cash flow. And the definition of shareholder yield is cash dividends, share buybacks, and debt reductions. And when Bill Priest wrote a book in 2005 trying to capture the essence of free cash flow and shareholder yield, we started searching for those characteristics and factors from companies in the marketplace. Since then, they've done very well in terms of returning capital, producing returns with a lot less volatility than the market.
Let's talk a bit about what QE has done to the markets right now, because again, we could spend an entire time right here just talking about your strategy, but you're very focused on cash flow and the yield side of things. But how has QE messed up the markets?
Well, in essence, what QE has done is it's taken the left side of a normal distribution, the basis of many financial theories, a normal distribution curve, and eliminated it. We call it the put, the Bernanke put, the Yellen put, the Draghi put. And by forcing or encouraging in a kinder way investors to seek more risk, the attitudes of the market are, well, if it starts to stumble, they'll just lower rates again. And that changes the way people fundamentally invest. A lot more dashing for trash.
How does that affect then, how you look at the markets moving ahead? I mean, it's got to be tough because some of that return has to come from valuation and finding the right entry point. And when those entry points get pushed up, it's got to be tougher.
Well, in essence, we don't look for the entry point per se. What we look for are companies that generate cash. Good companies create their own bank account, the cash flow for which they can then create further value down the road. And when we look at companies, we ask ourselves, do they generate free cash? Then, do they allocate it, do they invest it for future growth, or do they give it back to shareholders? And in shareholder yield specifically, we look for a recurring quantity of capital, about 6% every year, with a 3% growth rate to deliver that aspirational return of 9%. I've not mentioned valuation once.
As I've noticed. What about, let's go through some examples, because I think that way if you give us an example, you can paint the picture and what you see in terms of an interesting company. National Grid is one company, one of your top 10 holdings. Why is that an attractive holding for you?
National Grid has a long history of paying a high dividend, 5+%. They've done so from a mostly regulated business model. So 98% of their cash flows are known going into the future. The deal has been set. The regulatory environment in the United Kingdom is designed to replace an aging system of transmission grids. To encourage National Grid and others to do that, the regulator set up a scheme which allows investors to see the capital investment plan, the quantity of capital, debt or equity that's required to execute that plan, and the reward, the return on equity, the return on debt that's permitted under that plan. So as an investor, I get to examine each of those elements, take a good hard look at whether or not I think it's likely or unlikely that this scenario will transpire, and I get paid my dividends. The business grows, and they can do it again next year. So in doing the analysis on National Grid, we came away with a very favorable attitude towards the company, particularly in an environment where interest rates might be rising. When the United Kingdom sets the allowed return, it's tied to the rate of inflation that's occurring in the spring and in the fall for these companies. That process, again, allows us to examine the dividend and the sources of dividend payment in the context of the world as we see it. That's given us the confidence to put National Grid in the portfolio.
Another name that you have here as well is Vinci. Tell me a bit about this one and why it's there.
Vinci is a French construction firm. About 40% of its revenues and profits come from, or less of its profits, come from building things like airports and highways and other infrastructure projects throughout Europe and the world. They have a phenomenal emerging markets business. Right now they're doing projects in Vietnam, in the Middle East. The historic payout's been about 50% of profits have gone to the shareholders, and the balance been invested in projects to grow. The real value in Vinci is they oftentimes retain the concession to operate the highway or the airport or the facility. That's 60% of their cash flows come from this very stable source, which allows them to pay a high recurring dividend from a very visible source, despite the fact that they're in a business which most people deem as more risky. The concessions business dampen the risk.
How do you, I mean, I know part of your process when you go talk to companies, you spend a lot of time talking to management and trying to understand their business and sustainability of the business, obviously, and the cash flow. What are you hearing that's different today in this environment, in this economy, that was different than, say, 2-3 years ago?
I think 2 or 3 years ago, companies were a little more optimistic. The slow pace of the recovery worldwide has really gotten managements to be far more cautious in their statements, particularly the large mature corporations that we look at in the shareholder yield strategy.
If you take a look, I mean, a lot of people are arguing right now with QE that potentially it could be wrapped up in October. At some point, rates could be moving up, although a lot of people aren't saying exactly when. They seem to have changed that. But with your 9% strategy, how will rising rates affect that strategy as you move forward?
Well, clearly when you increase the discount rate that you're using to value future cash flows, the simple math behind a net present value equation or a discounted cash flow valuation, as you raise the interest rates, you'll lower the net present value. That's a headwind to all financial assets. However, equities with a growth rate to them have the opportunity, the possibility of offsetting that rising interest rate by having cash flows grow. And when there's a disciplined application of the cash flows back to the shareholder, the shareholder's yield, the shareholder's return grows. So when we look at the opportunity set in front of us, even with the possibility that rates may rise, and we don't think they'll rise dramatically, the world still presents us with plenty of opportunities to invest in.
We have been, and I'm sure you get asked this a lot, I think over 700 days now without any type of significant market correction and more than 10%. What do you expect to happen? Where do you see the markets going?
Right now, we expect the markets to continue this kind of, it's hard to call something that keeps setting new records range-bound, but the reality is the market is just grinding higher. There isn't really hard driving fundamental support for the market to move materially higher. So over the near medium term, we kind of expect things to continue as they are with this kind of grinding higher momentum. We're medium and long-term investors, so realistically timing this, worrying about a 10% correction, is it an opportunity to buy, is it a moment you must sell? We don't look at the world that way. We look at the companies in the portfolio and ask ourselves every day, are they contributing to the shareholder yield factors we're seeking to collect? And when they are, we move on to the next stock. We move on to the next stock. We make sure that the names in the portfolio are doing what we expect. And then we add the next new name to the portfolio that's going to be able to move the whole group forward. In that process, timing becomes less relevant. We are investing for the medium and long term. We're not going to try and pick the moment when the market's going to peak or fall.
Well, I'm glad you took a moment to join me. Thanks so much.
My pleasure.
Eric Sappenfield, he's Managing Director of Epic Investment Partners.